One of the most natural questions in investing is this: why should I pay 12 times earnings for a good company when I can buy another company at 4 times earnings? At first, the cheap company looks obvious. Imagine two companies. Both earn 100 units of profit today. The first company trades at 4 times earnings, so the whole business costs 400. The second company trades at 12 times earnings, so the whole business costs 1200. Same current profit, but one stock is 3 times more expensive. So, the question then becomes, why would anyone buy the more expensive one? This is exactly the question Warren Buffett had to work through. His mentor, Ben Graham, was the master of buying cheap stocks. Buffett later called this cigar butt investing. You find a bad or mediocre business that is so cheap that there is still one last free puff left in it. You buy it cheap, you get that puff, and then you move on to the next cigar. That strategy can actually work, and it was a great strategy for Ben Graham's time. But over time, Buffett moved away from it. And the main reason was actually Charlie Munger himself. Munger pushed Buffett toward a very simple idea. It is better to buy a wonderful business at a fair price than a fair business at a wonderful price. So that sounds like a nice quote, but I am not here for poetry. I want to explain the math behind it. And if you enjoy breaking down ideas like this, please hit that like button and subscribe. It really helps the channel. Alright, the key variable is return on equity. So let's go back to our example. Company A is the good company. It earns 100 units of profit. But to produce that profit, it only uses 500 units of equity. So its return on equity is 20%. Company B is the worst company. It also earns 100 units of profit, but it requires 2000 units of equity to produce the same profit. So its return on equity is only 5%. And this is where the difference starts. Both companies earn 100 today, but they are not equal. One is a 20% compounding machine, the other is a 5% compounding machine. Now, for a moment, let's assume both companies reinvest every dollar of profit and keep earning those same returns. If both can retain and reinvest all of their earnings, the good company can turn each retained dollar into much more future profit. The worst company can also reinvest, but the results are weak because the business itself earns weak returns. After 10 years, assuming the multiples never change, the difference becomes obvious. The good company grows earnings from 100 to 619. At the same 12 times earnings multiple, the business is worth around 7400. You paid 1200, so your money became more than 6 times of what you put in. The worst company also grows earnings from 100 to 163. At the same 4 times earnings multiple, the business is worth around 650. You paid 400, so your money became only around 1.6 times of what you paid. And this is the important part. There was no multiple expansion in this example. There was no hype, there was no re-rating. The good company stayed at 12 times earnings, the cheap company stayed at 4 times earnings. The only difference was the internal engine of the businesses. One engine compounded at 20%, while the other compounded at 5%. Over 1 or 2 years, the cheap stock can easily win. But over 10, 15 or 20 years, business quality starts to dominate. Time is the friend of the good company. Now, this part is important. All of this math assumes the good company can keep earning 20% on its reinvested capital for a decade. That is a big assumption. You have to actually understand the business, its moat, management's capital allocation, competitive threats, to judge whether that high return is sustainable. A fantastic past does not guarantee a fantastic future. That is why Buffett's favorite business model is one where it not only earns a high return on equity, but is also able to keep investing the capital it earns at those high rates. That is also why Charlie Munger said that over the long term, your return in a stock is not going to be much different from the return earned by the underlying business. If the business earns 5% on capital for decades, you should not expect magic just because you bought it cheap. Your returns will be close to 5%. And if the business earns 20% on capital for a long time, even a price that looks expensive at first can still produce a very good return. That is also the basic idea behind 100 Beggars. The point is not that every good company becomes a 100 bagger. Most of them will not. The point is that massive returns require two things. You need a business that can compound at a high rate, and you need the patience to let that compounding actually happen. In 100 Beggars, the basic lesson is buy right and hold on. That sounds easy, but it is not. Because the market always gives you a reason to do something. A stock is down 30%, earnings are weak for 1 year, interest rates change, some macro fear happens. There will always be a reason to sell. But if the business is still improving, if the moat is still there, if the return on capital is still high, and if the management is still allocating capital well, then selling just because the stock moved around can be a very expensive mistake. This is why good companies are so valuable. They give you a better reason to sit still. A bad business bought cheaply usually requires action. You need the market to re-rate it. You need the discount to close. You need to sell when the stock reaches its fair value. So time works against you. It is more of a trade. But a good business can keep increasing fair value year after year after year. You do not need the market to agree with you immediately. You just need the business to keep compounding. There is another piece here too. Many mediocre businesses are capital intensive. They need constant reinvestment just to stand still where they are. A steel company, a low margin retailer, a heavy manufacturer. These businesses may report profits, but a lot of that profit has to go right back into factories, machines, inventory, maintenance, and working capital. So the accounting profit may look real, but the cash does not really reach the owner. The business keeps eating the money. A great business is different. See's Candies is the classic Buffett example. See's did not need a massive amount of capital to grow. It had a strong brand. It had pricing power. It could actually raise prices and keep selling the product. It could generate cash far above what it needed to reinvest. The cash the business actually produced, what Buffett calls the owner earnings, was almost entirely free to be taken out or invested elsewhere. That is a beautiful setup, because the business is not just profitable. It is profitable without constantly asking the owner for more capital. That is what you want. You want a business that can either reinvest at high returns or send excess cash, like See's Candies, back to shareholders through dividends and buybacks. The worst situation is the opposite. A business that earns low returns, needs constant capital, and still looks cheap every year. That is how investors get trapped. The stock is always cheap, but the business never compounds. So the first principles question is very simple. What happens to $1 retained by this company? If one retained dollar becomes much more than $1 of value, you probably have a good business in your hands. If one retained dollar becomes less than $1 of value, the business may be destroying value even if the PE ratio looks low. This is why I think investors should own good companies. Not at any price. That would be stupid. Price still matters, but quality matters because time matters. Lots of matters here. If you are holding for 6 months, maybe the 4 times earnings stock is actually better. If you are holding for 10 years, the economics of the business become so much more important. A low PE tells you what you are paying for today's earnings. Return on capital tells you what those earnings can become in the future. And in long-term investing, that second part is usually what matters the most. A bad business, bought cheap, can give you one good puff. A great business bought at a fair price can keep working for you over the years. So that was Buffett's transition from buying statistically cheap stocks to owning compounding machines. And that is the real reason to own good companies. I want to point out here again, the good company here has a low maintenance capex, like See's Candies. But unlike See's, this good company is also able to reinvest its capital at those high rates. If you have heard Buffett talk about See's, they have tried everything to move that business in other states than California, but they failed. And the dividends have been going back to Omaha to be redeployed elsewhere. So See's is a good business too, but the example that I used here is actually even better. And good luck finding those. They are the holy grail of investing. Now, if you found this video useful, I think you are going to love my Patreon page, where I share deep dive analysis of the companies I found most interesting. The link is in the description. I am getting great feedback on the Kospi analysis that I recently shared. It's a 2-part breakdown that is over 80 pages combined. Thank you for listening, and I will see you in the next one. Bye.